Thank you very much. Alexei, I'm very honored that you invited me to speak here. But I need to make one introductory statement. When I was invited, Alex asked me to speak about my experience in risk management in my years as a manager. So what I'm telling you here today is not an official statement of 262. It's my personal view and my personal experiences. Let's see how it works. This is who I am. Alexei already said I have been a C-level manager in various companies, basically companies that were subsidiaries of a bank. The industries were banking, barter trade, and real estate. Barter trade I did in the Gulf states, basically, so I know a little bit about your country. I'm a consultant since 2010, and I'm head of communications. I'm vice chair in Germany of the
вице-президент.
I'm the head of the German delegation, but I'm speaking as
Я президент ДИН комитета, и я председатель немецкой делегации. Я бы хотел рассказать вам о традиционном управлении рисками до 2016 года. И я хотел сказать, что о том, что система рисками управления не существовала до 2009 года. Рассказать, как она должна быть после 2009 года. И рассказать о системе управления рисками ISO. Традиционная система управления рисками, я только говорю о контексте Германии, он управляется государством. Это имеет государственные контакты, у него государственный опыт, он был введен в
1998, sorry, with contract, which is the law for the transparency in companies. And it says the managing board has to prove that all reasonable steps have been taken for early detection and control of risks. Otherwise, the management might be liable for damages due to faulty organizations. Now, this directly applies only to listed companies, but you know, as lawyers are, and I'm a lawyer, we like to expand the rules, so it is expanded to every company. Since it was not sufficient, it was followed up by BILREG, which said incorporated companies have to make an assessment of the expected developments, including the significant chances and risks. And you can see here that we are not totally in line with ISO 31000 because we are talking about chances and risks, which many people in the Anglo-American, Australian community don't really like because they say that's the wrong approach, but this is nevertheless the continental European German approach, and explain them in their annual statements. And in 1909, BILMOG was added, which said the annual reports of incorporated companies oriented at capital markets have to explain the internal controls and risk management systems. Okay. In 2006, or before 2006, I was CEO of a mid-size real estate company. It was a leading real estate company within the city-state of Berlin. Give me a second, please. I'm sorry. We were owning 800,000 square meters of commercial real estate in 50 locations in Berlin. A real big company, renting to small and mid-size companies, in particular to startup companies. We were part of the commercial development organizations of the city-state of Berlin. We had a staff of approximately 100. Half of them were facility managers, the other half was administrative staff. The value of the property is 180 million euros. within the book, and the market value probably approximately 500 million euros. Annual rental income 42 million, and our most important risk was vacancies. Our second most important risk was devaluation of real estate properties, because in the early 2000s values went down in Berlin. We had a steep rise, we had a bubble of real estate before in the 90s, and then the bubble exploded and devaluation of real estate properties took place, which was a real problem for most real estate companies in Berlin. Our most significant asset was we had an equity ratio of approximately 50%, which is extraordinarily high for a German company. Normal ratios are about 10%, 15, and our significant risico asset was we had a wide spread of the risk. We had 1,500 clients, really spreading the risk. We only had one cluster risk, and this was a public entity. It was a university, the Technical University of Berlin. So what did we do? We followed contract and we did quarterly risk reporting, saying we did not really do continual risk management. The department heads allocated reporting to various employees. Task manager collected data, the so-called risk manager, and I'm sorry to say I don't think there is a risk manager, and I'll tell you why later on. Aggregated the data and filed them with the management, and the management presented it to the supervisory board, and then they were filed away. And 3 months later, the whole process started again. Nobody did anything with it. Risk reporting was a descriptive documentation of the risks. They were generally not quantified. No back references were made to the annual statements or to the audit report. So you see a lot of deficiencies, which I'm just listing. It was only an ad hoc use of the risk report for internal audit. We simply had a three-color statement, like a traffic light, red, yellow, green. And we, of course, we described the development of the risk over time. So this is basically how our report looked like. What our report looked like. We got critical, moderate, and low. It was not quantified. It was an intuitive traffic light. And I like to describe this as a so-called CMA approach. You know what the CMA approach is? Cover my ass. This is how it might have looked like, and we were about to proceed developing it. Just give it some quantifying additional items, and you can see what my recommendation would have been. Consequences: below 1%, below 5%, below 20%, and above 20%. Now you might say, hey, that's crazy. There must be more steps, and you must differentiate between 50% and 80% and something like this. No, you need to take into account human factors. And human factors are never exact. And especially managers of human factors have to be taken into account. So you better give them a clear way what they have to report. And managers are always inclined to say, oh, this is not really more than 50%. But they'll have a tough time saying, well, it's not more than 20%. So it's a rough steps. And then the consequences, insignificant consequences with below 1,000 euros. below 5% of the profit, below 33% of the profit, and above 33% of the profit, because this is when it starts becoming a real significant consequence. Okay, now we go to the next period. No risk management before 2009. I switched companies. I was CFO, COO of a group of transaction advisory companies, one of the big 5 in Germany. We tried to cover the whole value chain of real estate, starting from acquisition, brokerage, asset management, property management, letting, brokerage, and valuation of, and sales. We had a staff of approximately 100, mostly very well educated real estate managers, experts. The company was under Swedish ownership and had acquired the German part some years ago, keeping the old management but being very dissatisfied with the old management. So a new great group of managers came in, new but very experienced people, and I was one of them. Our task was to really finish or to really onboard the German entity into the group and to develop it from a mere brokership to a transaction advisor. We were very successful in the beginning. I started working with them in 2006. We reorganized the group within 6 months, which was a very short period of time for the size of the group. Everybody was telling me, why, what did you do? How did you do this? You should have taken a year or more. And we were generating profit while we were doing this. Well, that was really good. Smart people working there, not the other ones, not me. Making profit while we were reorganizing. We were the kings in 2007. We were advisors to 3 of the 15 largest transactions in Germany, and one of them was the largest office building transaction ever in Germany, with a value of 2.4 billion euros, with 48 buildings. So we were making lots of money. Now 2008. You know what happened in 2008? Lehman's and the missing awareness of risk. Nobody had expected what would happen in 2008. No one. Neither did we. We were of the typical management approach. We know our business. Don't bother us with time-consuming risk management. As long as the market is up and expanding, everybody will buy like crazy, and we'll be advising, and we'll earn money, consulting transactions buy side or sell side. And if the market should ever go down, well, don't worry, everybody will be selling, and we'll be making money advising the sellers. What happened? Well, you all know. There was no market anymore suddenly. The market went down from 60 billion euros in 2007 in Germany to 20 billion in 2008 and 10 billion in 2009. No transaction was larger than 100 million, and we were specialized in large transaction. Our market was not there anymore. Outcome? We sold off our property management division. We reduced staff in the brokerage division. We closed down our valuation division. And a management buyout of the asset management division with a staff of 15 nearly failed. The owners were a little bit inexperienced in transactions like this. They made a law firm doing it, and the law firm was a law firm and not a a transaction company. So at the last minute I came back from vacation and I saved the transaction, and it happened. Otherwise another 15 people would have been without a job. It wasn't funny, laying off people and things like this. So yeah, the biggest risk of all is no risk management at all. Doing no risk management. I think this is what Kevin will tell you. Just on a side note, there was a UK-based approach on roads to ruin, published in 2011, but covering the time 2000 to 2007. A case study of 18 companies. 7 companies collapsed. 11 departures of CEOs. 4 prison sentences. Followed in 2013 by a case study on research roads to resilience by the Cranfield School of Management and ERMIC. And what did they find? They listed 7 key points of failure, and I just listed 3 of them here. Board risk blindness. We are the kings, we know our business, huh? Don't tell us about risk management. Board risk blindness. Effective internal and external communication. Don't talk to us. We know what we are doing. Organizational complexity and risk from remuneration studies. Now, yeah, remuneration structures was a problem with us as well. Okay, thank you. Resilient companies, they found, have exceptional risk radar. You can read this. I think Alex is going to put it on the internet. Risk management since 2009. Now you know, you probably know ISO 31000. There's 3 columns. You probably think this figure is familiar. It should be. It's figure 3, basically figure 3 in the standard. I just want to point out 2 principles to you, which I think are amongst the most important, or even the most important principles, which is principle B. Risk management should be an integral part of all organizational processes. And principle G, risk management shall be tailored to the organization. And I don't want to run through ISO 31000 with you, but I want to give you a short thing on principle B. This is a core risk management process, which is with blue, highlighted in blue. You will see I added 5.7, which is risk reporting on risk management. I think the figure 3 is not totally complete, but okay. And you have to integrate it into all organizational processes, it says. Well, we have discussed recently that it's not only processes, it's not all organizations are process-driven, it should be activities. This includes decisions as probably the most important activities. And the core process is just like a loop. You plug it in like my picture, not everybody likes it, but my picture like a IT dongle enhancing your management activities, the quality of your management activities. Just one quick look. This is a slightly different way of explaining the process, and it shows that it's a little bit more complex. The core process on the right side, the risk management loop, it shows that it's an iterative process partially. So you go back after finishing one step to a step forward, and you plug it into all activities. And how do you do this? Very simple. This is a different way of showing a process in your organization. Does this have a pointer? No. I'll do it differently. You have a core business process down here. So you start somewhere. There's different steps you have to take to proceed in the process. and you plug in the risk management loop whenever there's an information or decision or an estimation. And you do this loop, and then you continue with your process. And in the end, whenever there's a new information or an additional estimation, you do it again. And sometime sooner or later, you're finished with the process. Now, I give you, and I'll be finished in a minute or so, 2 sentences about ISO activities for risk management standardization. ISO, in its directives, has an NXSL, so-called NXSL. And in this NXSL, it says in the appendix, the organization, well, this is not literal, but it's the content, what it says there. The organization shall plan actions to address the risks and opportunities and how to integrate and implement these actions to its management system process. Now you have heard something which many risk managers don't like you to hear, because TMB in its wisdom made the word pair of risks and opportunities, and this is not what you should use if you want to talk ISO 31000. Nevertheless, this is the wording of the so-called high-level structure. It's an identical core text and common terms and core definitions that form the nucleus of future and revised management system standards, MSS, and aimed at enhancing the consistency and alignment of those management system standards. Now I say, and this is again my very personal view, many will disagree with this, I say some of our fellow technical committees are a little bit misguided by saying, oh, this is the risk-based approach. ISO 19600 is an example. Or we are talking about risk-based thinking. ISO 9001 is an example. And then 9001 says, and we have been doing this all along, don't bother us with this problem. This is not very good. But it's a first step. What are management system standards? There are 2 types. Type A, containing requirements. Type B, guidelines, just short. They all have an identical structure following the PDCA approach. You know, Deming cycle, plan, do, check, act. And you can read all this later on. And the risk-based approach, so-called risk-based approach, is in section 6.1 and 8.1 of the high-level structure. I've printed part of it, excerpts of it for you here to read, and I think this is where I'll finish and allow for any questions. Proszę, спасибо за вашего внимания.